people are looking at different things. Like there's 17 different versions of what revenue means. When you say revenue, you can mean so many different things. You can mean order revenue, total sales, net sales. Like there's infinite numbers for what that could mean. And I think it's really important to just like align on what that number actually is that you're trying to pay attention to. And then I think a lot of times we've worked with clients that they come in with the expectation that we're going to be looking at what Facebook ROAS says. And it's like, well, it should be deeper than that. It should be what's your AMER, what's your NCAC, generally speaking. I think there's other things that you just want to align on. So I think a lot of times they fail because there's unclear definitions of metrics, which is
everybody thinks that they should send less emails, but they should actually send more. It's like you can do like more of the right thing is essentially what he said, right? And not be hesitant about that. And I think that's a huge difference between where we were and where we are in terms of understanding to like you're brought in as growth person, like you need to be focusing on new.
Unless you're a subscription brand, you shouldn't be paying attention to it as a metric to optimize off of like CAC to LTV. You just shouldn't pay attention to it.
Yeah. It's way too misleading, really.
It's way too misleading. You have no indication of what that's going to look like for your cash flow. I think too many agencies, like especially on Twitter, have like talked about like optimizing off of LTV. Unless you're subscription, I think it's a horrible idea.
And now, let's take a listen to the Scalability School podcast.
I was always so glad to be here with you guys. What's going on?
90 degrees in Wisconsin.
It's
Heat index of 100 something.
Talking about weather, very Midwest start to a call.
Yeah. It's bad.
Talking about
It's
Craig
bad.
Culver, the Midwest billionaires, just normal topics for us to have.
Yep, normal stuff.
Otherwise, nothing. Let's get into it.
Otherwise, we've all been on calls. Yeah, nothing interesting. Yeah, so today we're actually talking about dashboards. So dashboards that actually drive decisions and what matters for D2C brands and e-commerce teams. So let's just get right into it. Like dashboards, why they matter. Zach, obviously you've been on both sides of this equation, the agency and on the brand side. What would you say of like why dashboards often fail? What are the pieces of it? Is it too much information, lack of accountability? Is it that plus other stuff? What's your opinion?
This episode is brought to you by our friends over at Northbeam, the marketing attribution platform that a lot of us that listen to Scalability School and the hosts of Scalability School, we swear by and use. Northbeam rolled out something brand new that I think is pretty awesome. It's a real unlock, I think, called Clicks plus Deterministic Views. And it's the first ever deterministic view through attribution model. I mean, let's be honest, right? One day Click had us flying a little bit blind. You know the drill, right? Your TikTok or your CTV campaigns are building awareness clearly, driving site traffic and lifting sales across channels, but your attribution dashboard still gives all the credit to Google search because it was last click. It's like tracking who made the final shot in a basketball game, but ignoring the 5 assists, right, that got the ball there. So Clicks plus Deterministic Views flips that. It ties actual impressions, not guesses, but verified impressions to real conversions. We're talking direct integrations with Meta, TikTok, Snap, Pinterest, and even CTV. And Northbeam uses hard identifiers like order IDs and hashed emails to prove that someone saw the ad, didn't click, but later bought. That means you can finally measure the real impact of upper funnel campaigns. And the results are pretty nuts. One brand saw 283% more attributed conversions on TikTok. Another got 175% more attributed revenue than they knew even existed. And, another one drove 159% ROAS lift on Pinterest. So if you're tired of under budgeting awareness because attribution can't keep up, this is your chance to see the real journey and the full journey. So Northbeam Click plus Deterministic Views is live now. Head over to northbeam.io/demo to book a walkthrough and tell them we at Scalability School.
I mean, I think the number one thing is like lack of input to make sure your dashboard's actually dialed in to be telling you data that you really want to know and see. So my example of this is Triple Whale, which is a great tool all of us have used. And it's a tool that we started using at Homestead really early on. I think the biggest thing is that we've seen brands, when they don't spend enough time building out all their expenses and all the things that actually go into what it takes to run their business, so that when a media buyer, an agency like us, for example, or even just anyone on their team is trying to like make decisions on a day-to-day basis, isn't getting the full scope, truly the full scope. Every dollar that goes in and out of the business, having that a part of it, you can make decisions off of really bad data really quickly. So I think first things first, like getting everything robustly built out on the back end of a dashboard is probably the first big mistake that I see happen, or the first big thing that we really try to push for our clients and even just for our own brands.
Yeah, it's that financial understanding of getting, knowing what they need to be successful. Brad, when you dive into this, and you're helping a client figure out this out. How do you help them understand like the distinction between a dashboard and a report? And especially if they're trying to scale quickly, like how do you make sure that they're looking at the right things?
Yeah. Just to add on to what Zach was saying, that like what can go wrong from our perspective is just like people are looking at different things. Like there's 17 different versions of what revenue means. When you say revenue, you can mean so many different that you can mean order revenue, total sales, net sales. Like there's infinite numbers for what that could mean. And I think it's really important to just like align on what that number actually is that you're trying to pay attention to. And then I think a lot of times we've worked with clients that they come in with the expectation that we're going to be looking at what Facebook ROAS says. And it's like, well, it should be deeper than that. It should be what's your AMER, what's your NCAC, generally speaking. I think there's other things that you just want to align on. So I think a lot of times they fail because there's unclear definitions of metrics, which is the unfortunate nature of like just dashboards, I think, have been a little bit pervasive and making things a little bit confusing in that regard. But for us, I think that the primary distinction between those two is reports kind of like a snapshot of a moment in time and like how things have trended. And dashboarded for us is like live view. So we use TripleWhale. I'm an investor, I should probably say that. So like we use TripleWhale for all of our clients. It's solid. It works for what we need it to. It's a little expensive, transparently, but it does the job. So we set that up with all of our clients. We send them a video of like, here's what these things mean, and here's the order in which we do it, which I'm sure we'll get into. And then that powers the reports. So we just grab screenshots of those things and then add context into what the numbers mean from our end.
I mean, I feel like a simple error that's just like very basic is, are you including like returns in your reporting, right? Because if you're including returns in your reporting and then you have media buyers making decisions off of that, like for Hollow, we started the day with $8,500 in returns. Just boom, right out of the gate, right? So if our head of growth jumps in there and is like, hey, performance is horrible because they're not taking into consideration, oh, those are returns which need to be treated separately than actual revenue that's happening from today, you can make a lot of bad decisions. So that's just like a great relevant example of like something that I feel like people can just, if you're not paying attention to the finite details of what the actual sales metric is, like Brad said, it's pretty easy to make mistakes just looking at the data.
Yeah. So let's talk about like, I think one of the pieces that happens, there's so many places you can go with this in terms of the complexity of it. So the essential financial layer, I think, is, contribution. Brad, let me know what you guys think about this, but contribution margin with and without Amazon, estimated net profit, including estimated OpEx, and variable costs. What do you guys think about that in terms of like the main things? Brad, I know that was on your dashboard that you shared. Those are the things that you're looking at above all else, basically.
Yeah. So we try to organize our dashboards in order and our reporting in order of like least variability and its ability to be confusing. So I'll explain what that means in a bit. But basically, contribution margin at the top, like minus the return thing, which can cause some confusion. I think that's a great point. For the most part, it's like that's the reality of the financial reality of your business pre-OpEx. And then if you can estimate OpEx because I have these salaries or these leases or whatever, like I know these things are coming, I think having that combination on a daily basis is like, there's no lying. If your net profit is negative, you know you're in a little bit of a precarious spot unless you intentionally plan for it to be negative because of some LTV consideration. So having that at the top is the first thing that you see is probably stressful if it's negative, but it's really important to know that it's negative so then you can work your way down and make some decisions.
Brad, do you want to explain contribution margin versus like gross margin per se?
Yeah, sure.
For the listeners who don't know what that word is and have heard it a million times on Twitter, but maybe just never Googled it or actually had to think about what it is.
Yeah. Well, then there's probably also several definitions of it. But the way that we look at it is order revenue. So it's every single dollar that you take in minus cost of delivery, which can be defined in a bunch of different ways, but it's effectively what's the cost of your product? What does shipping cost you? What is taxes? Did you give away a free gift? Like that is cost of delivery. It's everything associated with getting the next sale. Like you have to incur this expense to sell the product. That's cost of delivery. So what you collect in revenue minus what it costs you on a variable basis to sell that product. And then the next layer of this, so that's gross margin. To get to contribution margin, you subtract out ad spend per order in total, however you want to look at it. That's how we get to contribution margin.
How does this relate to, I think a lot of people, when they start building dashboards and going through, this has certainly become a part of the conversation the last few years, but I think a lot of folks still focus only on return on ad spend. And I think that as a marketer, like I didn't come from this as a business owner. As a marketer, this is what we were taught and brought up to look at. It was like, we're looking at ads, and that's what I look at to gain my success. How do you bridge the gap between trying to teach people contribution margin, gross margin, and then their ROAS, and how do these things relate? I mean, obviously this is just a different part of the dashboard, but how do you guys think about that?
I have a lot of thoughts. I can start. So we look at a couple of different versions of like MER and ROAS. So I'll try to be very specific in the way that I'm using these terms because I think they can be confusing. When I use MER, generally speaking, I'm talking about some blended version of everything, right? It's total revenue across the entire business, which is Shopify plus Amazon or just Shopify if you're only on Amazon, but it's that divided by ad spend, blended version of the business. When I say ROAS, I'm generally talking platform specific because I think that helps me like distinguish the difference between them because I know a lot of people say blended ROAS and that starts to get confusing really fast. So MER is kind of this blended version. And there's two main ones that we generally find ourselves looking at, or maybe we add a third in there. It's MER, AMER, which is going to be new customer, and then ROAS. And if you're just looking at ROAS, I think oftentimes it can cover up a lot of different things. Just if like you're only looking at MER, it's not uncommon for us to come into a client's like do an audit and we see that MER looks great and they are losing their ass on new customer acquisition and they have no idea because they've never looked at it. And platform ROAS looks great because they're not excluding existing customers. They've got 1-day view in there. They're sending a shit ton of emails. You know, it's like, so I think like having those different views allows you to just like troubleshoot the problems. I don't know if that answers your question, but that's like how we look at it.
Yeah. I mean, I think, that's exactly how you look at it. Right. And I think one of the biggest differentiators, I think to Andrew's point about going from thinking about ROAS versus not is your business can be more profitable on a lower ROAS if your revenue is higher, as long as you're offsetting your operating expenses. I think like that is probably one of the biggest lessons that we had to learn for our clients and teach our clients and then do for our own brands is that, you know, a lot of people have an expectation of, hey, we need to be at a 3 MER for every, dollar in ad spend, we need $3 in revenue. There's a chance that based on volume and based on offsetting your operating expenses, even with like, decent COGS or cost of delivery, like you could be more profitable at a 2.7 versus a 3 MER at more volume. And sometimes more volume is easier to achieve than even higher MER. So I think it's all like in comparison to what your target and what your goal is. But to Brad's point, like you have to be looking at each kind of one of those. So I think Brad, you should start ripping through like what's the next slot in here.
Yeah. So let's talk through this. So I'm dragging us down in little things. So you start with, Brad, you're talking about contribution margin with and without Amazon, estimated net profit using estimated OpEx, overview. Then he goes to overview and then total revenue. And so go through like, because I think what we would ideally want to do is give people the ability to build the ultimate dashboard that you have that you're following because you're my guru.
Good. Hopefully I'm not like one of those weird gurus. Okay, so I will go through those. I want to just touch on a point from what Zach was saying there, like the difference between, I think people hear more profitable. And a lot of the times where we've gotten tripped up on that with folks is like, they're looking at profit margin as a percentage. Like, yes, your profit margin percentage is probably going to go down if you're taking less MER, but if you scale more, the dollars go up. And I think that's a really important distinction. There's probably a whole nother episode in talking about the efficiency trade-offs of scale. There's a whole spreadsheet and calculation we can go through. Okay. But back to the dashboard.
Should we just like close the loop on that real quick? So the way that I think about that, just real quick, just because I brought it up and I feel like it's my fault if I don't close the loop. For us, like for Hollow, for example, if our goal, I'm throwing out numbers. Let's say our goal is 5 million in profit for the year. It very likely will be much easier for us to achieve 5 million in profit on 40 million in revenue than 5 million in profit on 10 million in revenue, right? So the idea here in theory is, okay, what with more volume to offset my operating expenses, if I'm looking at like just MER as my target, I could actually lower my MER target with more volume and actually produce more profit at the end of the day. It's just a volume game. So I just wanted to like close that loop of where I was at. Yeah. Okay. Sorry, Brad. Keep going.
Yeah. There's a Connor from Ridge has a very like underrated hidden YouTube video that if you ask me about, and if we could find it, maybe we'll link it somewhere, that like he talks about that. And it's great. It's very old. But okay, back to the dashboard and kind of how things are ordered. So here's how we order it. At the very top, we go with some version of contribution margin with or without Amazon. If you care about that view, I like to see the difference between them, and then net profit. And you're just using an estimate of OpEx because obviously you're not reconciling OpEx in real time, but that's just kind of an estimate. So contribution margin, net profit at the top. The next layer of this is kind of like the overall, what I would call business metrics. I should shout out CTC for this at least to a little bit, because I think a lot of this was inspired by some documentation they put out years ago, which was great. So that business metric layer is going to be some combination of revenue, spend, and MER. And if you have Amazon, it's Shopify plus Amazon in your revenue. It's Shopify plus all DTC spend for your spend section, and then you're creating some kind of version of blended MER. So the one that I'm looking at, maybe we can include this as a screenshot somewhere too, is what I call Omni revenue, which is Amazon plus Shopify, Omni spend, Omni MER, and then it goes to ad spend. Yeah, things like that. So that's kind of that overview layer. What's nice about that overview layer is you can quick see, is my MER on track with the goals that I have for the year or for the day or for the week? And you can get a quick snapshot. If it is on track, great. You might still want to go to the next layer to make sure you're not you don't have a huge problem that you're going to uncover from there. And if it's below, great. You can still go to the next layer and try to figure out why it's below. But I'll pause there on the business metrics section. Any questions about those?
No, I think you should go to the next stage.
Cool. So the next one is going to be the customer metric breakdown then too. So it's going to be new customer revenue, CAC, AMER, and then some kind of version of how many new orders you're getting. But it's this view of the business on a new customer level. So revenue, CAC, AMER, new customer orders. Maybe you want to throw in new customer AOV because that's probably differs from your repeat business, but just gives you a sense of that. The reason that this is super important, I think that this is what is like historically been missing from a lot of brands that we come into, is they're looking at their Facebook ROAS, they're looking at their MER, maybe, and they're like, cool, on raw track. All right, my business is dying. I don't know why. And you go one layer deeper and you say, oh, you've not generated any new customer revenue this year. You've just been hammering emails. So your revenue looks great. You're discounting crazy and things look really good. But this layer allows you to see, are you actually acquiring enough new customers to continue like fill up the overall pie to keep your business on a healthy trajectory. And then like in that same bucket, you can break out returning customers in the same way. So returning customer revenue, returning customer orders, AOV, things like that.
Amazing. Yeah, I mean, I think for us, one of the biggest things is helping brands also realize, like, depending on how hard you're pushing and like what your goals are for the year, like for Hollow, we're trying to push, 100% year over year, is what you can expect with your new customer, with your new customer CAC, right? So like for us, I'm just like pulling the data, and if Triple Whale loads quickly, I'll be able to list it off. We are up 110% year over year as far as like year to date. Our new customer ROAS is up 14%, but our new customer CPA is also up. So meaning that we were able to increase our new customer AOV by 46% year over year. And that's the only reason why we've been able to continue to grow. So again, like if you're not looking at new customer AOV, new customer ROAS, new customer CAC, like you're going to miss one of those pieces that is throwing off, oh, hey, our MER looks good, but our profitability is shit. Oh, it's all returning customers. And because all of our new customer like acquisition and everything, all the efforts going in there are just like not contributing well to the whole ecosystem. So I think like you have to look at each one of those pieces to then identify the holistic problem versus just trying to say, what's the issue at the end of the day?
It's a great point. We literally just went through this with somebody where it looked like MER was, so they were up like, call it 30% year over year in revenue, but spend was up 80%. And MER was like, oh shit, this looks bad, like not trending in the right direction. We're not as efficient as we were. But then if you go a layer deeper and you look at this new customer piece, their new customer piece was scaling at the same pace as their ad spend, and their AMER was flat. The problem was repeat customer was down. Okay, well, why is repeat customer down? Well, okay, they sent half as many emails this year as they did last year. It's a brand where that's really meaningful and it drives a ton of stuff. For you, it could be maybe you didn't do as many offers this year as you did last year. You didn't keep up with your promo calendar. Maybe you didn't release products on the same cadence. Maybe you had a cohort of customers that got shit product and they were really mad about it and they didn't come back, and all of a sudden your cohorts are messed up, and that's a layer you want to dig into. But that's why it's really important for us from our perspective is like, if we're the ad agency, and I'm coming at it from an agency perspective when I say this, we're doing what we said we would do, which is growing the new customer piece of it. With this reporting, what we can say and what we can help the brand uncover is, okay, you didn't send as many emails, you didn't do these things, but like there's something about this repeat that you need to dig into. And we can clearly see it because it's split out. And that's hidden if you only look at MER, and it looks like we're just spending money inefficiently.
Yeah, when I was at the founders meetup the other week, Jacob Sappington, I said, "What's one thing with email that, and retention generally, that people don't consider?" He's like, everybody thinks that they should send less emails, but they should actually send more. It's like you can do like more of the right thing is essentially what he said, right? And not be hesitant about that. And I think that's a huge difference between where we were and where we are in terms of understanding to like you're brought in as growth person, like you need to be focusing on new, and that's definitely a good thing to go on the next level too. The platform level overview and then pacing. So let's talk about those two things that you go through.
Yeah. So then the platform level overview is just like trying to get yourself a quick snapshot of how each of the channels are performing. If you're the way that we operate is we're kind of looking at how did yesterday perform, how's today looking so far, how does last 7 days look. So if I'm going through these kind of like order of operations of just checking in on the health of things, your MER can be on track, your AMER can be on track. But if you have a ROAS target on Facebook of a 2 and you're at a 1.5, okay, on a 1 day window, maybe you don't want to like raise any alarms yet, but what you want to start paying attention to is like how are the platforms changing and influencing the above metrics. And there's probably a whole discussion to get into about incrementality because that's the buzzword of the year, and like how should you set your platform targets. I think a simple way of thinking about it for now is just looking historically and just mapping out how AMER looks against your meta ROAS as an example, and then just kind of like understanding that relationship. So when my meta ROAS says 2.5, I know my AMER is about a 3. I think House just released an incrementality report that said on a 7-day click basis, Meta's underreporting by 15%. So you can use that as a benchmark if you have no incrementality thing to go off of. But the quick platform snapshot just allows you to see like are each of these individual platforms kind of on track with the platform goals that we have. So then pacing is, you can put this into the dashboard. We put this into a spreadsheet primarily because I don't think that there's a way to my knowledge to put goals directly into Triple Whale and just like see how you're pacing against an actual goal. You can see how you look period over period or year over year, but that doesn't really tell you how you're pacing against goals. So we have a pacing sheet that basically is like literally day by day, what are all these metrics? And we try to focus in on the ones that we care most about. So, a lot of clients will be, okay, what is our MER? What is our AMER? What is our revenue? What is our spend? Maybe those are the core metrics and things you care about. Contribution margin should probably be in there because we just talked about how important that is. Point being, you pick those 3 to 10 metrics that you want to track on a daily basis and then map them against the goal. And now you have this spreadsheet that says, okay, on July 23rd, which was just a couple of days ago at this point, I can see how I looked against the goal. And then you can start to build this map of how you're pacing for the month. Basically, for us, it's just to look and say, okay, are we spending efficiently? Can we push harder to either produce more contribution margin? Maybe we're outspending the goal that we had for the month, or do we need to pull back and try to preserve MER to close out the month? From an agency perspective, it's just like helpful to have that to make sure that we're on track with what we said we would do. And then for clients, it just gives them quick visibility into like how things are performing if they don't want to open up a Triple Whale dashboard for whatever reason. People are comfortable with spreadsheets. So just a quick way to see how you're looking against the
and
actual
are you using
goal.
like rolling averages to smooth out things like on noisy data points, or do you ever set like tolerances, like where if the ROAS is up 30% and then you look at the trailing average, or is it just like a pacing look, like generally overview?
Yeah, literally just day by day. I think the rolling stuff is really valuable when you're starting to use it to make decisions, but the pacing sheet is just to see like
it is what it is.
Yeah. Revenue versus revenue goal, spend versus spend goal. Very, very plainly.
So you then go into, let's talk about cash flow for a minute. This, I think there's a lot of different ways you can think about this in terms of looking at the dashboard piece of this, but I'd be curious about how you think about like burn versus profit visualization, cash on hand forecast. And do you do any like inventory looking in that within cash flow as well?
Yeah. So these couple of other things are things that we try to just like, cash flow is a little bit tricky for us as an agency because I think it requires like way more insight into inventory POs and things like that. That gets just a little bit tricky for us. But you can have an estimated version of what cash flow might be for the day. So maybe we'll have a metric in there that tries to estimate what cash flow is, or you create a separate dashboard for managing that. The other things, a couple other quick things I will maybe like to check, not every single day, but every couple of days, is just like outside of cash flow is going to be like, how are my products selling individually? If we have multiple SKUs, like what SKUs are selling well today, which ones are selling well to new customers versus returning customers versus the whole piece of it. And just kind of like keeping an eye on how all of that's trending to see, okay, are there any other areas of opportunity? We have several clients that just have like a ton of SKUs, and sometimes like you can see new ones pop into the top 5 over a 7-day window. And if we don't have a campaign live for that, that's a good signal to maybe say, okay, maybe there's some seasonal moment hitting, maybe there's some organic moment that hit that we want to consider, and maybe we can pull that into a campaign to push it a little bit further. Zach, I don't know if you have any better insights around cash flow specifically and how you guys are looking at it. I'm just not super useful on that.
Yeah, I mean it's not in a dashboard. Like it's in Google Sheets. We're building out like 13-week cash flow statements, stuff like that. I think like even on the agency side, we're usually not looking at that. It's usually like net profit goals for the month, and then making sure our clients are like filling in as much in every detail as they can into Triple Whale's like expense settings that we can actually see what's going on. And then you kind of have to have a little bit of a holistic view. The other big thing when it comes to that too is like, depending on how much, if like everything is filled out in there, you can like start every day negative. So technically like you start the day with like negative OpEx. So you're starting the day maybe with like a 6K loss out of the gate, because you have team cost and software and everything else that it costs just to run the day-to-day of the business. So I think it's also interesting to like call that out, because I wake up in the middle of the night sometimes and look at stuff and I'm like, whatever, we're at negative 10K to start the day. And I'm like, oh, okay, this is going to be a fun one. And then
That
I have
keeps
to
you
remind
hungry, man.
myself, yeah. And then you have to remind yourself, oh yeah, it's like just the OpEx reset for the day. So yeah, anyways, I think that's mostly how we do it. So a lot of the financials and stuff like that, we go Google Sheets, not necessarily dashboard based. It's just too many moving pieces, bills get moved around, stuff like that. It's a little bit harder. So mostly it's like net profit per day is what we're looking at.
So let's talk about like LTV. Brad, you had that listed, and want to talk about is it LTV by cohorts over 30, 60, 90, whatever? When you do that, do you ever pull in like payback window visualization or anything like that? I guess I'm just curious how you handle LTV. Obviously Zach, you as well, done a lot with sub brands, and
Yeah. So we will look at LTV it's not a daily, probably not even a weekly. Maybe it's more of a monthly thing, just to make sure that cohorts are behaving in the way that we anticipated when we set targets. To my point earlier, if all of a sudden you sell a consumable product and you were sending, I had this experience recently where I got protein shakes and they tasted like cigarettes when I tasted them. It was crazy. So like, yeah, that's a really bad experience for a customer. They're probably not going to come back and buy from you again. And like all of a sudden your LTV cohort for that month looks like shit. So the way that we're looking at LTV is when we're setting maybe ROAS targets, we can bake in, especially if it's a subscription heavy brand, we can look at the cohorts and say, what can we expect to get over a 30, 60, 90-day window? And then maybe we can adjust down our ROAS target according to that. And it will just be, the traditional kind of like cohort view where it's month by month of how that looks. Maybe you'll add some filters in for what product people purchase first, things like that. But yeah, it'll kind of give you that payback analysis in there. Zach, anything to add on LTV?
My like maybe not so hot take on LTV is like, unless you're a subscription brand, you shouldn't be paying attention to it as a metric to optimize off of like CAC to LTV. You just shouldn't pay attention to it.
Yeah, it's way too misleading, really.
It's way too misleading. You have no indication of what that's going to look like for your cash flow. I think too many agencies, like especially on Twitter, have like talked about like optimizing off of LTV. Unless you're subscription, I think it's a horrible idea. Unless you're, a 9-figure business or high 8-figure business and you have 5-6 years of solid historical data to actually back into that. If you're sub 20 million and you're less than 5 years old and you're mostly focused on one-time purchase, products and customers, I just wouldn't look at it. Again, subscription, completely different business, right? Then that's completely what you're optimizing off of. Once you can cash flow to the point that you can actually say, hey, I can actually lose 10, 20, 30, 40, $50 on this first purchase because my LTV within a 90-day window is going to have me fully paid back and produce profits. It's a completely different scenario, but I think that's where, like for Hollow, we like don't really look at it. We are paying attention to it now, and our biggest thing that we're trying to optimize for is more about the time gap between purchases. So like we've now spent a lot of time looking at purchase 1 versus purchase 2, and the average time was like in the 70 days over the last 365 days. Like over the last year, it takes like 70 days on average for someone to come back and buy again. How can we close that window? To me, that's a more important metric to pay attention to than LTV. So again, like we'll look at it. We don't pay attention to it for Hollow, but for other brands, we care more about it.
Yeah, I think that's like a really good point. Like maybe there's so all of these things that we've talked about up to this point are maybe like daily, weekly, monthly things that you're reviewing pretty regularly. This LTV thing, particularly if you're not a subscription heavy brand or, you're not building a bunch of like crazy forecasting models based on it, but you're in a similar business to Hollow, maybe you should set up a quarterly cadence where you go and review these things and you set some goals like you just did, where it's, okay, I know my people are purchasing between here and here, and this is how many days it takes. I want to improve that. Here's the things I'm going to try to do to improve that. And then you go back and you review it. Maybe that's the cadence for how to think about using that, is set up a quarterly, monthly, whatever. You go check on it and you try to do something with it. Now, ultimately, it should ladder up into a bigger goal, which is improving repeat customer revenue. So it needs to ladder down from that. It can't just be, yeah, I want people to buy more frequently and you're giving away all your margin. But I think we talked about this on a previous episode, Zach, where something you guys were going to try was just being more aggressive in your repeat customer offers because you've already acquired the customer. There's margin to be had there. F around, find out with the offers there.
So one quick aside. Well, do you want to respond to that, Zach?
No. We can keep going.
Okay, so one quick aside is I've heard both of you say privately in conversation with other people about subscription brands and how great they are, and convincing and like saying to other entrepreneurs like, hey, you should think about having this be a subscription brand. Right now, how do you help a company transition to thinking about that? Because I think it is a great idea. It's like it makes it a better model. Why do you guys think it's a better model? And just like really quick aside on subscription brands and why is it so powerful, do you think?
I mean, it's, for Hollow, we can kind of bank on like 25 to 30% of our revenue on a monthly basis being returning. If you're a subscription business and you like play it right, it could be 50 to 60 to 70% of your revenue on a daily basis. So it just makes much easier the idea of growing a business. It just makes growing a business much easier once you have people coming back every 30, 60, 90 days. And that's really the simple answer of why it's better, right? Is like you're getting them to come back and spend more money. The real like crux of it is like you need a good product that people will actually come back and buy again and not cancel, right? So there's like some baseline metrics of like what you can kind of anticipate of like churn on a like 1 through 6 month kind of period. A lot of brands, that we see that are like trying subscription or trying to do subscription well, will be at like a 10% retention at month 6, right? When we look at the brands that have done subscription really well, they're much closer to 50% retention by month 6. And if you get to 50% retention by month 6 and you're billing on a monthly basis, let's say your AOV is 50, like we're talking about, a $250 LTV on like a $50 AOV product. Your CAC to LTV, if those are your actual metrics, can be absolutely insane. You could spend $100. You could literally be at a 0.5 new customer ROAS on a daily basis, and it still backs out to being profitable for you. So that's where like the hack comes in, is when you have a great product, you have good retention, and that compounding effect actually starts to set in, that you're bringing back so many returning customers on a daily basis that your new customer CAC can go way down. And that's where your CPAs in a Facebook or in whatever, these are the brands that we're seeing spending, 7 figures a month on ads, because they can run at a 0.9 ROAS and it's great for their business, right? So I think that's like the big thing now that, Brad and I have talked about and we've seen clients do, is just like that's the big hack for them, is they can just run at a completely different mechanism than a normal brand that runs on a 2 new customer ROAS versus a 0.5. It's just a whole different ball game.
Yeah, it's a really beautiful thing, actually.
Yeah, just probably don't do it for your first product business because you will probably lose your ass.
Yeah. I mean, I think that's the other thing to be said, is like that's a great model, but you have to prove that the product's great first, right? And that customers are actually going to come back and buy again. Otherwise, you can shoot yourself in the foot and basically say, "Hey, I can spend $100 acquiring a customer that spends 50 and then never make that money back," right? So it definitely takes some proof of concept and proof of returning customer before you can go that route. But once you have that, and once you feel like you can validate that, trying to push more on the subscription side than just focus on one-time purchase, obviously it can be a big unlock for a lot of these brands.
I mean, I'm bummed, Brad, you're not going to come back and purchase my Marlboro cigarette protein powder.
You know what's
Again,
crazy about that?
that's too bad.
You know what? We're bringing beefs back early today. I want to tell this story, and I don't know how many people are going to hear it or care, but like I've been buying
Tens.
these, tens of them.
Tens of listeners.
There's a company called Only What You Need that's been resold several times to private equity, probably a few times. I might be butchering that. I've been on their subscription for protein shakes for probably 5 years. I get 3 boxes a month, which is like 36 shakes. And I get them every single month for 5 years. Like that's a lot of money I've given these folks. I got a package. I opened it. It tastes like cigarettes. I email them and I'm like, this tastes like cigarettes. Like, can I get my boxes replaced? Because they literally all 3 boxes, all 36 shakes taste like cigarettes. It's disgusting. They're like, oh yeah, sometimes it happens with natural protein, whatever. I was like, no, that's fine. I get it. I've been drinking these for a while. I'm willing to get it replaced. They send me 1 box to replace it. And I'm like, I bought 3 boxes. They all taste like shit. What are we doing here? And they're like, oh, we gave you that as a favor for being loyal. Like, what? You're not doing me any favors. You send me cigarette tasting protein shakes. I've given you thousands of dollars. What are you talking about? So I canceled my subscription that day. And I'm moving. I'm now a Koya, as these guys know.
We're not vegans.
Protein.
Yeah. I don't know what that is.
But anyways, that's my don't piss off your customers story.
There are, I think in all seriousness, I think that one of the benefits of being marketers who own businesses like you guys, is like, and myself with the founders membership and the other like related businesses we have, is we all go through stories like that all the time. And if you notice it and care, it will set you apart just by the natural fact that you've been a marketer and you're like working with clients, running an agency, and you're like, what the hell? Why wouldn't you replace that for that person? Because I'm over here getting blown up in the ad comments about this or whatever. Like, you see it and you know it, and that's like a big differentiator. Okay, so taking us back to the dashboard for a second. So, all right, so you go through all this and you've gone through cash flow. We talked about LTV. Let's talk about product breakdown and day of week sales breakdown in Shopify. How do you look at those and how regularly are you looking at those, Brad?
Yeah, product breakdown is probably closer to like a weekly thing, and it depends on the brand, right? Like if you go to a single SKU store, you never need to pull this up. But once you start to get a couple of variants, that's when it starts to become a little bit more meaningful. I'd say weekly, one from an opportunity standpoint, like I said earlier, to see if you can add something into the ad account because it's picking up volume and you don't have it, it's not represented in the ad account currently. And then the other thing is just like, if you have an expectation of a certain product carrying the load and all of a sudden that thing starts to fall off, you want to keep that in mind because these, if you're building an inventory forecast based on an expectation of certain products making up a certain mix, and all of a sudden one of them starts to rip and you're scaling ad spend and the other one's falling behind, but you have a shit ton of inventory in the other one, it starts to get weird really fast. And maybe you need to spend more time trying to figure out how to move the product that's not moving, or saying screw it and just scaling the thing that is working. I don't know if you have anything to add there.
I mean, this is just like the crux of Hollow for this year is that we find like it takes a few months. We launch a new product. It takes a few months. We get some like banger ads working, and then we like stock out of the product. And especially when you launch new products, you're forecasting. You're just coming up with ideas of how many units you think you can sell, and you don't really understand like what the market really will say. And it's just a risk, like profile that you have to set on a new product when you launch it and say, hey, I'm willing to, order 50,000 of these units or 5,000 of these units, and let's just see what happens. So yeah, I mean, for us, for Hollow, we're looking at this almost on a daily basis at this point because we have close to 100 SKUs now. And just like the fluctuation from going last year from having like 40 SKUs to 100 SKUs is just like completely different. Our year over year comps are just absolutely ridiculous, and trying to like set expectations from that is just really hard. So I think for brands that are growing and trying to add new products, which is like when we're talking about LTV and trying to get people to come back, that's a lot of it, is adding new products and giving customers a reason to come back and buy from you again. This part is really hard to do. I mean, in all honesty, this is probably like one of the hardest things that we've struggled with this year is just like not building enough surplus, but also not like shooting ourselves with like, ordering too much of one product that we have sit on then for an entire year because it's seasonal or something like that. So yeah, for us, again, like the complexity of the business, the more you'll spend time on this, easier the business. You don't even have to worry about it.
Yeah. Day of week and time of day. You want me to jump into that?
Yeah, let's do it.
Yeah.
I actually think these are, particularly the day of week, I think is like massively slept on. I think everybody kind of has this intuition around when their business is more or less efficient, and maybe not even efficient. I think some people will be like, yeah, my weekends are great. And some people will say my weekends suck. Zach knows that when he wakes up at 3 a.m. to take a leak, he's going to be negative 10K in the hole, whatever. But like by noon, maybe he's positive, and then the rest of the day is gravy because he makes, so like I think from a time of day perspective, I think it's helpful to just like understand that cadence, especially if you're, one of those surf scalers or whatever they call it that are scaling the budgets intraday. I think it's really important to have that context. And then the day of week, like I perpetually see, particularly brands that run really heavy on like lowest cost, they just like probably lose their ass on certain days with the idea like it'll be made up on the weekend. And I think that that is a mistake in many cases because I'm not sure that you're actually creating demand for the weekend personally. But I think it's important to look at that because we have a client literally every Friday, particularly because they're a little bit more on like lowest cost right now. It's like we're lowering the budgets into the weekend because their weekends are horrible, like horrible, and there's no evidence that spending through the weekend makes the week any better. So we always pull back. And for a lot of brands, it's the opposite. Like I wouldn't be surprised if Saturday or Sunday for a lot of brands is like some of the bigger days of the week to a massive degree. And it's not even just revenue. It's a combination of revenue and efficiency. And getting that day of week with efficiency is a little trickier to pull, but I think it'd be really valuable. One caveat that I'll throw in here is like you launch products on a certain day of the week or promos on a certain day of the week. You got to be careful how you look at this because that will throw that off. But yeah, so I think it's slept on.
Yeah, I mean, for us, like for Hollow specifically, as we've been using that example a lot, like we lose our ass most of the time during the week and then make it all back up in tenfold on the weekend, right? So Mondays are brutal, Tuesdays are like usually pretty shit, and then it's just like trickle back up into profitability and then just like let it rip through the weekend. So
yeah, I think the weekend stuff's so interesting and it varies by business, so I think it's a great thing to track. One thing we haven't touched on is like ad metrics within Meta, which I think is great that we haven't really gotten into that, right? Because we're talking about the actual financial health of the business first, and this is a podcast for 7 to 8 finger brand owners primarily. What metrics are most important though to you guys when it comes to talking about ad creative and what you're looking at to know that you have winners?
Yeah. Well, I think what's been interesting about this, and hopefully the takeaway is if you kind of go in order of the way that we've talked about this in the podcast, you can kind of go through the what's most important in order. Because I think the dashboards start to change kind of by role. So if you are the owner and the media buyer, obviously this, the media buying stuff is relevant for you, but what you might be looking at from an owner perspective or an agency perspective might be different from what your day-to-day, everyday media buyer is looking at. So in Meta, what we're generally looking at is going to be spend and purchase conversion value. And I think the reason we do that is because purchase conversion value purchases like everything closely related to the sale. Honestly, most of the way in spend. And the reason that we do that is because from what we've seen in the analysis that we've run, they correlate the heaviest with actual new customer revenue, which is what we're trying to drive. Purchase, if you're, depending on how your account structure, is very likely to be more heavily correlated than even purchase value and purchases. And I feel like that's a hill I will comfortably die on for now, but I'll probably change it at some point. So spend, purchases, purchase conversion value, NCAC, AOV inside of the platform, how those things are looking. And then something else that we try to pay attention to, particularly on an ad level, is just like, what does spend velocity look like after you launch an ad? So a report that we keep in our creative reporting tool is called new ads last 14 days. And the reason we do that is when I launch an ad, if it starts to pick up over the course of the first 3 days, I might be onto something. And I think that's really worth paying attention to because usually ads pick up within that first couple of days. And if they don't, they tend to not pick up. So spend velocity is another thing that we'll pay attention to.
Did you steal that spend velocity from me, Brad? Or did you
No,
teach
I've
me
got
that?
screenshots back. You scroll back on my Twitter. There's screenshots. So no,
We've,
but I think you've coined the term a little bit more recently,
No,
for sure.
yeah, it's fine. I'll take all the credit. No, that's it. Weirdly enough, that's been something that we've been repeating myself, been paying way more attention to is that spend velocity. It's absolutely crucial when you're trying to find breakout winners in your account, when you're seeing an ad go live. And even if performance isn't where you need it to be, but Meta is just like eating spend into it to then go make decisions off of, okay, like how do I change the hook? How do I change some part of the body that needs to be swapped out? That's probably the biggest one, which we pull through Motion. We don't pull it through directly through Ads Manager. But yeah, other than that, spot on with Brad. Nothing else I'm looking at. I'm not looking at hold rate. I'm not looking at thumb stop. Not looking at impression conversion rate. Not looking at that stuff. It's basically just spend, purchases, and ROAS.
Yeah. Something that I want to transition to, and this will be like a quick thing to close out from a creative perspective, is like how your categorical spend changes over time. So what I mean by that is like if you can start to lump your ads into different themes, like, okay, my spend is going into this age demo or this pillar or this angle or this persona or whatever over time, it might start to change. I just did this report for a client year to date. It was insane, like how much it changed. And like intuitively, when you map it to the marketing calendar and you think about the seasonality, like it makes sense. But once you start to see it tied with spend and efficiency numbers, yeah, that might be a whole episode on its own because it's kind of cracked.
That's an interesting idea. Yeah. I mean, spend velocity trademark, stack stock, is a huge new way to look at it, and I think that's true. And I think a lot of us are shifting in that direction as we start to look at ads because it just gives a clear signal, and it's also the way that Meta thinks. I think it more closely mirrors the way that Meta thinks about things, which is helpful. We're still obviously looking for us, or at least early reads, because a lot of the accounts and audits that we see, some of these people are smaller spenders accounts. So we sort of have to rely to some degree on click-through rate, hold rate, hook rate, thumb stop ratio to have an early assessment, because we're not going to have spend velocity is not something we can achieve because we just don't have the capital to be able to deploy to like get a real read on. So we have to look at these early indicators to say like, okay, actually this seems to be better, right? Whatever the thumb stop ratio or whatever, that we should lean into this a little bit more. And because we have a lot of our brands and members are running big accounts, but we also have a group in the United Kingdom and the EU of like smaller spending accounts that are saying sub 50,000 a month, and sometimes they're even sub 20,000 a month, and it's like that's a different ball game for a lot of those folks. So yeah, interesting. So I mean, I think ultimately wrapping all this together, dashboard best practices, right? I think it's supposed to accomplish like any dashboard / let's talk about dashboards, not report, but a report would hopefully accomplish this as well. Is the business healthy? Are you acquiring customers profitably? And are you retaining customers efficiently? And are you avoiding like vanity metrics? What other things need to be accomplished in every dashboard? I mean, for us, I will say that creating a routine around and ritual around a dashboard for the business with our clients was the most effective thing that we did. We're going to look at this together at this time. This is when I will be looking at it, and this is when we're going to be having a conversation about it. And it just became an atomic habit that we really instilled with our clients. Make sure the conversation was taking place properly, because otherwise it was a scattershot. Did you see this? Did you see this? Did you see this? And it didn't create a like synergistic conversation really. It was just all over the place. So what else do you guys think?
I think that's a great point. Like, I think having a cadence for when you look at it and why you're looking at those things is really valuable, because you probably don't want to freak out on just a one-day thing. Now, there's some caveats to that, but as you start to notice some trends, particularly if you have a forecast and you're off forecast and you're consistently off forecast for several days, then that becomes okay, what else do I need to dig deeper into? And maybe that's another episode that we can do, which is like actually going through a dashboard and like, okay, this was off track, so this is what we did next. And I think just going through those order of operations. But yeah, having a cadence for reviewing it with like an intent of why you're reviewing it, super valuable. For us, it's daily, weekly, monthly, quarterly, yearly. It's kind of the way that we look at really this entire thing, not just like specific metrics, but all of the metrics that we just mentioned.
Yeah, no notes. I mean, the only other one that I feel like is like a slept on in Ads Manager metric that I look at that not a lot of people do is cost per added cart. Depending on your brand, there's a very good chance that you can correlate the cost per added cart in Facebook to cost per purchase, even better than cost per initiated checkout. So if that's something that you're like not spending that much money and you're trying to figure out, okay, are there leading indicators that are, showing promise? Sometimes cost per added cart can be a great one for you to look at, especially if your volume's not there. So wanted to throw that one out there.
Well, to our tens of listeners out there, thank you as always for listening. And we are grateful for you. If you have feedback or thoughts, always let us know. Andrew at foxwelldigital.com, and I'll get it to the guys on the team. Gentlemen, good to be with you.
Thanks, everybody else.
The only way that we grow this podcast is by you sharing it with your friends. Honestly, like reviews kind of don't really mean anything too much anymore. They're really meaningful, but they don't do a lot for the growth of the podcast. And so sharing YouTube links, sharing Spotify links,
sharing Apple, whatever we call it under the podcast app now. Anything you can share, the better we're going to be. Guys, anything else you want to say on this?
Yeah, please go check us out on YouTube. Rack up those views for us. We'd love to see it. And then subscribe. Make sure to subscribe on YouTube as well.
And I relentlessly refresh the YouTube comments because it dictates my mental health for the day. So please say something nice about all of us.
Thank you, everyone.
Thanks,
Thank
everybody.
you for listening, honestly.
This episode is brought to you by the Foxwell Founders membership that Andrew and his wife Gracie run. It has been absolutely pivotal for not just the Homestead team, but the Easy Street Brands team. We've had, I don't even know how many members are currently in there that are part of our ecosystem. But when it comes to anything from learning ads to understanding what's going on to building an agency to knowing retention, it's been absolutely useful for our team when they get stuck or they need help to just go there and resource all the other experts. So definitely would recommend it for anybody that's looking to, take it a step deeper, try to get a little bit more knowledge on growth marketing and all the world D2C is.
Yeah, I think one of the most incredible things about it is you can just open up the Slack group every single day. You can pin your favorite channels for the topics you care most about. And every day there's going to be somebody who just because they want to contribute something valuable to the group, you can go learn something every single day and it's going to be extremely useful. There's some ballers in there that you just get the benefit of learning from that. For the cost, you couldn't pay them that for their time, but through the membership, you get access to some incredible people and tons of resources.
I think the biggest resource to me too is the events that Foxwell Founders does. They've been able to do some, even in Wisconsin, even in the boring state of Wisconsin, which is pretty awesome, getting people together in person and able to have really just honest conversations of what's going on, what's working for them now, where they're at in their business, and knowing that there's going to be, like Brad said, some real killers in the space in this membership that can help and are willing to take the time and help. So that's been a huge part of why a lot of our team have really enjoyed it as well.
And applications are now open if you're looking to join. So
Foxwell Founders, Foxwellfounders.com. Go check it out. Go apply.